Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today I will handicap the community and regional banks with the theme, to bail or let it fail. My first blip is a reminder that the President and Treasury Secretary have repeatedly said the U.S. government will not bail out lenders. Last Sunday, the Federal Reserve and U.S. Treasury essentially bailed out Bear Stearns, which faced near certain bankruptcy on Monday. The regulators rightfully decided that the credit crunch could not handle a sudden stop in the daily business activities of a major investment bank with huge exposures to hedge funds through its prime brokerage unit. In my opinion, this deal will stand. It is likely that the regulators tried to find a buyer in the $15 to $20 range, but none came forward. My second blip looks at the two regional banks overexposed to construction and development loans. BB&T Bank, with $128 billion in assets, has $19.5 billion in C&D loans. These loans are 85.8% dispersed, so their issue is collection. BB&T has a risk ratio of 182 versus risk-based capital and should trade between $26 and $37 a share. Regions Bank, with $137 billion in assets, has $15.5 billion in C&D loans. These loans are 56.4% dispersed, so they are slow to lend additional cash to finish construction projects. Regions has a risk ratio of 122% and should trade between $18 and $26 a share. In my judgment, BB&T and Regions are too big to fail. My third blip looks at Wells Fargo, which has a huge exposure to home equity loans, and Washington Mutual. Wells Fargo, with $468 billion in assets, has $85 billion in home equity loans of the $607 billion reported by the FDIC in its quarterly banking profile for the fourth quarter. These loans are most vulnerable to failure if primary mortgage is held by a different servicer. If a homeowner is making mortgage payments to the primary server but stops making payments to Wells Fargo, the Wells Fargo cannot foreclose on the property. Look for a trading range between 24 and 34. In my judgment, Wells Fargo is another regional bank too big to fail. WaMu may be the odd bank out. JP Morgan was rumored to be interested in acquiring WaMu, but the lender was left at the altar given the shotgun wedding with Bear Stearns last Sunday. I cannot make the case for a bailout of Washington Mutual if one were needed. My fourth blip reiterates that there will be bank failures. Fed Chief Ben Bernanke told us a few weeks ago, and recently the FDIC began to rehire specialists that have experience in administering bank failures. I have shown the attached graph numerous times that shows 2,368 banks with risky concentrations of exposures to construction lending. I have also identified 467 publicly traded banks with an aggregate risk ratio of 185% to construction and development loans. This is the universe from which bank failures are most likely to occur. Keep in mind that we get a wave of first quarter earnings from these banks in mid-April, and I expect miserable results once again. Be sure to tune in to Right Side Live at 6 p.m. today for Traders Club. Send your comments and questions to support@rightsideadvisors.com. That's today's 4 in 4. Enjoy your day.